When you were in high school, do you remember there was that whole massive section in high school on economics? They're not teaching that at all now. There's more to it than just what's in the app, you know?
So the one thing I say is we still have to make sure that we are educating individuals every single day. Education is still key.
Does the election impact mortgage rates, right? So I wanted you guys to speak to that in terms of what actually impacts mortgage rates.
Rates are not impacted by the elections, and those factors have nothing to even do with the Fed does. The younger you are, and I'm going to tell your whole audience this, the younger you are, look at buying a home. The earlier you invest in real estate, the more equity and wealth you start creating earlier.
All right, y'all. Well, welcome to another episode of the Blueprint Podcast. Man, guys, I'm so excited about today's episode because I've been on TikTok, Threads, Instagram. I'm on all the social media platforms. And as a real estate professional, I'm always just trying to see what do people think the reality is about how to buy a house, and what questions do people have. Always looking for those things so I can be prepared to answer those questions. And guys, there is so much misinformation about qualifying for a loan. How much money do you have to make? What your credit score has to be? What the reality of what impacts the mortgage industry? And so today we're gonna actually talk to some real experts that do this every day. So I know you might be seeing the TikToks and the Instagrams, and you might be having a bunch of questions. Today we are gonna get you educated on what actually impacts rates, how to get a mortgage, how to buy a house, all the things. So we have in the studio with Mr. Chris Kelso and Andrea Fowler. Got connected with these guys recently, and these are people who do a great job and are experts, but they're also great humans, and they actually care about people. And so really excited to hear their perspective on the truth about how you can get qualified for a mortgage, or what do you have to do to put yourself in position to buy a house, whether 2024 or next year in 2025. So why don't y'all introduce yourselves, and then we'll just get on into the program.
Okay. I'm Andrea Fowler.
Yeah.
I've been in the mortgage industry for 23 years,
Yeah.
born and raised in Houston, grew up in the 3rd Ward. Been the last 8 years focused on Community Reinvestment Act mortgage lending,
Okay.
but also do the gamut of everything else.
Right. Okay. Love that.
So,
Cool.
Chris?
And my name is Chris Kelso. I've been in the business going on 24 years. Originally from Monterrey, Mexico, actually. So Spanish is actually my first language.
Okay.
And one of the things I tell everybody, we're sitting in Houston, Texas, where it's amazing. Houston does have one of the most diverse markets in the nation. So 43% of our population right now is Spanish speaking in origin.
Okay.
But one of my passions, and has always been, is helping first time home buyers get into a home and debunking the myth of the mortgage.
Yeah.
Right?
Absolutely.
Because what you just got through saying, I'm like, okay, yeah, that's absolutely right there.
Yeah.
All the things you talked about. So.
Yep. Yeah. And it's so interesting. We actually went viral a couple of weeks ago, and it was a clip. And me and a buddy, he's also a lender. We were talking about the DINK strategy. And so DINK stands for dual income, no kids, right? And so we were talking about if you're in a relationship like that, living off one income and saving the other one, right?
Yep.
And so we posted that, and it went viral, and everybody was in the comments saying, "Oh yeah, I did that at work," or some people were like, "Oh, it doesn't work." And it's crazy. When I bought my first house, I was making like $40,000 a year, right? And so not a ton of money, right?
Yeah, that's
and so for me, there were people in the comments like, "Oh, we only make 60K, or we only make 70K combined," and I was like, "Guys, I did 40, right?" So I was barely scraping by, and I was able to use the resources that were out there, right? I also have a buddy. He is in college. He goes to Rice. Okay, so one of the more expensive colleges you can go to. Found a way to buy a house, right?
Yep.
So there's always options. There's always creativity that you can leverage. And so I want to get into some of that. But Andrea, you mentioned the community reinvestments act and some of that. So talk about some of that, because I know you have a really a lot of experience in really just getting into the community and really helping folks. So kind of give us some more background on that.
Right. So in 2017, I was in desperate need of a job because I was right at the beginning of a divorce.
Okay.
And reached out to a friend of mine that had previously worked with me at another mortgage company, and he said, "Hey, come work for me at my bank," and because we really need somebody who's from the hood, essentially, to help us build and develop and brand a Community Reinvestment Act mortgage loan. So I kind of fell into it. It wasn't by purpose in any way, shape, or form. And at the time, even I was like, huh?
Yeah.
What's that? Well, finally, kind of went through the whole learning curve of it all, and then reached back out to a lot of the women that I've known since grade school, and got with them and started really learning about institutionalized racism and how a lot of that plays into the mortgage industry, and also the fear factor and the myths that we're here to talk about. a lot of it was me just asking constant questions of them, and thankfully, they love me enough to put up with me to answer all the questions.
Yeah.
But also just learning all the dynamics and all the laws behind it. But I kind of fell into it, and it was developed as a way to help borrowers who otherwise may not be able to afford to buy a home, buy a home.
Right.
And there's so many products out there. I mean, I say it all the time at our company. We have so many products that it would take me months to cover them all.
Right.
But there's everything from grant programs to DPAs. I mean, it's kind of mind-boggling once you really think about it, compared to how it was when we got in this business.
Yeah.
Compared to how it is today.
Okay. Are some of those same issues still here? And Chris, I don't know if you want to answer that in terms of, we had, some inequality in the mortgage industry. And obviously a lot of that's been deregulated out, right? I mean, there's really strict laws that
Massive
you do certain things.
switch
You
up.
can't. But obviously humans are humans. Humans are going to do their thing. So there's obviously discrimination, ways that people try to fling. So are y'all still kind of maybe even combating any of that, or any of that misinformation or anything? Or what's your thoughts on that?
I still say that here's the following. So you just said humans, right? And
Right.
human is the issue in that problem, right?
Yeah.
There's inherent racism, I think, still exists today on everything, right?
Right.
And that's just the reality of the market. I hate to say this, though. I can tell you this. Since I've been in the mortgage industry, I don't care what race, color, creed, religion, or sex you are. Generally speaking, the people who are taken advantage of are taken advantage of by their own kind.
Yeah.
Right.
You see
It
that
might
a
be.
lot.
It might be. The gay community with the gay community, or black with black, or white with whatever it might be. Right. Because individuals understand within their own culture the ignorances that exist.
Yeah.
Right. I just being honest, and so they take advantage of those ignorances. Right. And so the one thing I say is we still have to make sure that we are educating individuals every single day.
Yeah.
Education is still key. The great thing, the internet can be really good and really bad, right? It can be really good for individuals who might not know who to go to find somebody to go to. On the other side of things is there's a lot of people in the business, and you know this, there's a lot of realtors who don't do any business. There's a lot of loan officers who don't do any business. So then you contact one of those who don't do any business, and you're not in a better situation either.
Yeah.
So I also think there's some ignorance out there that is not necessarily ignorance that is trying to be ignorant towards a culture craze.
Maybe inexperience.
It's just the inexperience associated with it, right? So you come across somebody who doesn't know anything, but acts like they do, and then that comes across, unfortunately, as inequality, and they're just incompetent, right? It's a different type of thing right there.
Which is why I felt really comfortable having you guys on, because y'all have been in the game. Y'all have weathered the storms, right?
Well, and the other thing I want to add to that is then there's the fear factor.
Oh.
But, you add that into the mix, and it's a whole different dynamic, and especially within poorer communities. I mean, I didn't grow up with a lot of money. My dad was an artist. That tells you, and there were 5 of us kids. I mean, that tells you a lot right there.
Right.
But there's so much fear, and warranted to a lot of degree because of what we went through in 2008 and 2009 with the mortgage crisis. There are so many bad apples out there that hurt our, I mean, at one point we were literally, persona non grata. I mean, we were like the equivalent of Enron. Nobody wanted to talk to the loan officers, like, y'all bad people bad, and so I get it. You do get borrowers that we're always educating. That's their job. As a loan officer, your job is to educate your borrower and to protect them.
Okay, gotcha.
But the other side of that coin is you have to be met by a borrower who's willing to learn. And because of the fear factor and everything that they've been told, or the horror stories that they've overheard, or what have you, you're combating against that.
Yeah,
and
people who have in their mind, I can't do it, so nothing you tell them is gonna. My
so and so and so and so and such person had this happen and this and okay, well that was their experience.
Yeah.
So.
But let's face the fact on one thing. For example, we talk about this. Black homeownership, as an example, is at an all-time low as compared to homeownership in general. It's lower than the 1960s or 50s.
Okay.
Why? That should not be the case, right? And so again, number one is lack of education. Number two is a lot of people are taken out of the market sometimes. Right? They're taken out of the market, due to, I would say, and we talk about this all the time, mortgage companies might put into effect a rule or regulation that inadvertently takes away a buying group of individuals. Sometimes it might be Latin American, sometimes it might be African American, whatever it might be right there, right? And so the one thing is, though, we've talked about this today, is there's no reason why black home ownership should be at an all-time low. There's really no reason why,
Right.
other than education, right?
Okay.
And that's just one example, because Latin American home ownership is flourishing right now. You know, it's the
Yeah,
largest
it's
percentage
massive.
of home
Yeah,
ownership.
okay.
And if you go back into time, and in fact, I learned this in history at the University of Texas one time, you know, you go back into time in the old Western days, it was the Asians that were considered. If you look at the hierarchy of everything,
Yeah.
back then it was the Asians that were the ones who were doing everything on the back office. Now Asians' percentage of home ownership is at an all-time high.
Okay.
So
Yeah.
again, it's education, right?
Okay.
And I think it comes back down to always making sure that, number one, you see beyond the color of somebody's skin, but more importantly, you see inside what they're looking to achieve.
Yeah.
And I tell everybody is the first generation mindset has to be home ownership.
Okay.
You have to build that equity over a period of time so you can give your family and your children
Right.
that opportunity in the future.
Yeah, because I grew up seeing all my aunt and uncles owning homes. So every Christmas I was
Yeah.
going to people who own their homes. So
Correct.
for me, I was like, I'm gonna buy a home. Like it was just like.
See, and I want to speak to that. So I'm in my 50s, right?
Uh-huh.
And a lot of my girlfriends, their parents, it was black. It was, you know, there was no gray area. They either rented or their parents owned, and
Right.
it was nothing in between.
Okay.
And I want to speak to the education part. One thing I noticed that ever since they took, I don't know if it was like this when you were in high school, but when you were in high school, do you remember there was that whole massive section in high school on economics and
yeah.
taxes
Yeah.
and learning how to
They taught
balance your
taxes in
checkbook
college or
and
high school?
all that
What?
stuff.
That's crazy.
And they're not teaching that all now. My son
Yeah.
said that he maybe had like maybe half a period of learning about credit. I mean, I had
Okay.
to sit the boy down and teach him how to balance your checking account. He's like, well,
Yeah.
good enough for that.
Yeah.
No, there's more to it than just what's in the app, you know?
Right.
So
That's so good.
I think a lot of it is a lack of education, just simply because they took it out of schools. And so much within the community, especially in low-income communities, and I don't care what color your skin is, in a low-income community, there is so much that has been taken away that flows up and downward. You
Okay.
know,
Yeah.
upward in that as you're going up in the level of your life and your career and your age, you know less and less. Downward in that it affects your own children once you start having them.
Yeah. Okay.
Because children watch what their parents do
Right.
and do not do.
Yeah.
And one of the
Yep.
things when I was on the housing committee of the NAACP that we focused on time and time again was getting the kids involved, making sure the kids were well aware of what was going on. We made it a family affair to focus on buying a home.
Yeah. So
You know,
good.
if we could give out a book for everybody, it'd be Rich Dad Poor Dad, by the way.
Oh yeah.
Yeah,
I love
it's
that.
I mean,
Great.
just
That's
think
what got
about it,
me
Rich
into real
Dad.
estate.
You're actually sure, right? You know,
it's a
and the
great book.
concept of it, right? It
Yeah.
goes to what you just got through saying. You know, individuals who have will teach their children one way. Individuals who don't have will teach their children a different way, right?
Right.
And so, if anyone could learn, Rich Dad Poor Dad actually teaches you some of those basic fundamentals and principles you need to do
Yeah.
to become that next stage in life, to become that next successful entrepreneur,
Yeah.
home owner, business owner, whatever it might be right there.
Yeah, so good. It'll unlock your mind. So that's so good. Well, and I wanted to go that route so that the listeners, you guys can hear the heart that these guys have about just the world, the economy, because not every lender is the same, right? And I think
No.
I love that you guys have substance behind. You're not just trying to close the next deal. There's actually
No.
some substance there. And so I think one thing that's interesting, today is election day, right? So
Yep.
I feel like a lot of people are kind of waiting to see what happens,
Yes.
today to kind of like make moves in the future, right? So obviously that's impacted the real estate industry. We're kind of feel like there's been a little bit of a lull. But I think that's perceived, right? I don't think that's the actual reality. Does the election impact mortgage rates, right? So I wanted you guys to speak to that in terms of what actually impacts mortgage rates, and is the election already built in terms of the impact of the election? Is that already built into rates as they currently are?
So, I guess I'll grab that one because you're looking at me on that one right there.
Well,
Yes.
I know what I want
Yeah,
to say.
it's funny, because I told everybody today is gender identity reveal day or whatever it's called, right? We're gonna have a boy or a girl as the president,
Okay.
one of the two, right? So
Yeah. Yeah.
and it's interesting though because rates are not impacted by the elections. They're impacted by the elections in an inadvertent way, right? I wouldn't say it's not direct. rates are determined by a couple of factors, and those factors have nothing to even do with the Fed does. It has to do with what the 10-year Treasury is doing.
Okay.
The 10-year Treasury is based upon bond traders. Bond traders basically trading. It's an underlying commodity that you do, that you want to securitize more of your money, or you want to be more flexible. And bond yields, meaning the
Explain what a
interest
bond
rate.
is for people who
So
don't know
a
what a bond
bond
is.
basically is, if you look at it, a bond is when a
Securitized.
government is going to issue debt, right?
Okay.
And so they're going to issue debt, and they have investors that are going to buy that debt. And that, it can be
It's
a
a
bond
pool of
to
money,
It's
basically.
a pool of money, and it can be a bond as simple as you're building a new stadium, or you're doing services to a community, or you're building a new infrastructure. So it's the government servicing is what they're basically doing. And so the one thing that the government needs to do is they need to have people buy that debt so they can grab the money and be able to invest that, right? So the 10-year Treasury is actually where interest rates are determined from. And the Treasury is determined, right, that by the yield. And that yield is determined by things like CPI, which means Consumer Pricing Index, or core inflation, or super core inflation, or unemployment.
Dang, this is some nerdy
Right?
stuff, man.
So yeah,
and
so
non-farm payroll.
and payroll and
you know,
non-farming
yeah.
payroll. So
Yeah.
it has a lot to do with other things. So let me give an example. 6 weeks ago, the Fed came in and said, we're lowering the interim interest rates by 50 basis points. Now, what that means is that you have the Fed loans money to banks so they can float overnight, right?
Okay.
And that's the interest that they pay on that float to the government. So right now, it was like 5.75. Let's use that as an example. And so the government said, we're going to reduce it down by 50 basis points. So they reduced it from a 5.75 to a 5.25, just as an example right there. Well, that wasn't directly for mortgages. That was for the banks.
For the banks,
And that's going to impact things like credit cards or auto loans, or even the interest you're going to be earning from the bank itself. But it doesn't impact interest rates.
Okay.
But what happened is that the forward statements they said. So then they said, so we think the economy is going good. We're going to lower our by 50 basis points. However, we do feel there's still some issues associated with the
There's some
economy.
room
We
for
feel that
improvement.
inflation is creeping up right now. We feel that durable goods has an issue. Unemployment, actually, they had to readjust the unemployment numbers, and then they came in really strong again. And they mentioned about core inflation and super core inflation. So you started seeing all that. And so the traders go, oh, wow, well, we don't like the forward statement, so we're going to actually have to get more money on the trading of the bonds. Well, and that yield moves up, the interest rate moves up, right? Because now
And
traders.
so I want to
yeah.
clarify to consolidate that for
Yeah.
the. I know there's a lot of high level people who watch this, so they'll get what you're doing. But people who have
Absolutely.
never heard this kind of
So
conversation,
I'll give you the
yeah,
simple version.
Yeah.
Basically, the Fed is always late.
okay,
So the Fed
That's
is
true.
forever late.
Yeah.
Ever.
Yeah.
And the yield, so the yield is basically like if I buy the debt, the yield is like how much money I make off the debt, right?
That is
So
correct.
That's what the interest rate. So when they buy the government's debt at 5%, that 5% is what the person makes.
Is the interest you're
Yeah.
making on your
Exactly.
investment.
So that's why they
Right.
were like, they kind of want those numbers to be higher because that means they make more money.
Well, and they need to make more money.
Yeah.
And they need to make more money, right? But it's also a way of them being able to convince people to buy a government bond, right?
Right.
Yeah.
Because here's sort of thing is, if you have a lower yield and I can put that money in the stock market when the stock market's doing really good, I'm not going to buy that government debt at 3% or 4%.
So bonds are a
You know,
safety bet.
right?
They're a
But
safety
if I can get a
investment.
safety net at 5 or 6%, I'm going to go to the bond,
Gotcha.
right? So
right.
it's a hedge.
I'm going
Yeah,
to
okay.
interrupt him.
Yeah.
So that's why sometimes when you see the stock market doing horribly, all of a sudden everybody does a rush to bonds. That's why, because that's considered a safe investment. And sometimes they're short term, sometimes they're a little bit longer.
Okay.
But to really kind of dumb it down, the Fed's always late.
Okay.
Just know that. But they speak before they do. And when
Okay.
they kind of give their little hints, whether they're hawkish or dovish, you got all the guys in the markets looking at it going, okay. So everybody in mortgage-backed securities knew ahead of time, all right, they're all placing their bets that the Fed is going to move rates down by 50 basis points.
Right.
So at some point,
Yeah, they
like
did.
a 0.7 or
Yeah,
0.8 or whatever. So what happened was, leading up to that Fed meeting, interest rates were mortgage interest rates were
Okay.
already coming down.
Yeah.
So 2 weeks after the Fed met and they did the 50 basis point cut, And mortgage rates have already started to creep back up. So it's basically it's a sum zero effect.
Okay.
We're
Gotcha.
right
Yep.
where we were.
Okay, gotcha. So we talked about some misinformation out there. Now, this may not be misinformation. This is just a TikTok that I found, right? So I'm going to play it
Right.
for you guys, and I want to get y'all's live reaction, okay?
Okay.
So
Okay.
just went to TikTok and said, like, hey, what are the mortgage people talking about on here? So listen to
do
this.
that.
Good news is bad for the mortgage rates. Bad news is good for the mortgage rates. If you're watching this and it is the beginning of October, last Friday we got the jobs report, and it showed great news that there were more jobs being added to the economy. And whether that's real or not, that's just what the report was showing. However, this absolutely freaking tanked the mortgage rates. And in the past month, we have seen mortgage rates spike back up about half a point, despite the Fed cuts that happened in September. Because say it with me, when the Fed does rate cuts, it doesn't affect the mortgage rates. When the Fed does do rate cuts or rate hikes, it just means that they're changing anything that's variable. So like credit cards, student loans, even HELOCs, things like that. So if you have gone under contract, all of my people that went under contract last week, I locked them in because I knew
Yeah.
that this was.
So
Yep.
what I really what you guys to point out was we talked about the bad news, good news. So do y'all agree with that statement?
I agree with what she was saying. What she
Okay.
was saying was absolutely true.
Okay.
It is whenever you see a rate cut like that, remember one of the things that traders are always looking at forward-looking statements. That's
Okay.
what they trade on.
Okay.
Right? They don't look backwards anymore because backwards doesn't exist. So it's always looking at forward-looking statements. So when they look at they didn't look at the 50 basis points cut. They looked at the forward-looking statements that the Fed made.
Okay, gotcha.
Yep.
Okay. One thing that I wanted to hear from you guys, because I know you guys have, I know you said you have so many programs that would take you months to go through, but one particular one that I really want to lean in on is the programs you guys have for investors and entrepreneurs, right? And so I have a large group of clients and people that are in my audience that are fit into that category, right? And so we're always trying to figure out how do we get these people qualified, because they're they don't have the W-2s and the different. So
Right.
talk about some of the programs that you guys have, or even some of the myths that you think that you're debunking on a consistent basis that maybe the entrepreneur or real estate investor has.
So I've got a perfect example. I had a gentleman who came and applied with me. He'd been to another lender previously, and that lender had said, how you're doing your taxes, I cannot qualify you. You're writing off so much, which is well within your right to do.
Right.
You're writing off so much. There isn't any depreciation to add back in. There's nothing here for me to add back in as income. So we all know self-employed borrowers, it's like you're either paying the IRS or you're paying for it through a mortgage. So it doesn't really benefit you either way. I mean, it does, but it doesn't. Because somewhere along the way, you're going to pay for doing that. So that's something that, and I know that sounds negative, but it's just the cold, hard truth.
Okay.
Because that's the cost of doing business. That's the cost of wanting to buy, and it's the cost of wanting to do business and have your taxes be lean. So, with that said, we have bank statement lending, we've got 1099 lending, we've got every P&L, we've got it all, right?
Okay.
The other myth that I think this gentleman that walked into the process with was he still thought that he would get a 6.5% interest rate. That just isn't feasible.
Okay.
Because when you do something like a bank statement or a non-QM mortgage, which is not meant to be a 30-year mortgage, it's meant to be a stopgap until you can get to a position that
so you can refinance.
qualify
Okay.
for something with a lower rate.
Gotcha.
But when you walk into a non-QM, you have to understand that interest rate is going to be higher because there is more risk with working with somebody who does a bank statement or a 1099 or, I mean, everything with a mortgage is about risk.
Okay.
That's the number one thing that I think borrowers don't know because no one's ever said it.
Right.
And every level of risk, increase your rate just ever so much more.
Right. Okay.
I would say the following. I would say is if I'm working with investors, my first question is always the following. Are you investing for cash flow? Are you investing for equity? Are you investing for a long period of time, short period of time, fix and flip, et cetera, et cetera? And there's three products that I really, really like out there. Excuse me. Number one, DSCR.
Yeah.
Okay,
Yeah.
so
Heard a lot about that.
Great.
debt
Yeah.
service credit ratio. That you can buy the home, put 20% down, higher interest rate, but I'm not qualifying you on your income. I'm qualifying on the cash flow of the property.
Right.
DSCR to me is one of my favorite products I do for investors out
Okay.
there. Number two is private money.
Yeah.
a lot of individuals might be looking at a fix and flip. We do fix and flips, right? And we have great relationships with fix and flip companies.
And is that like a hard money type product with those, or is that still more traditional in terms of like the rate and kind of how the lending happens?
So it's more like a hard money, so it depends, right? I'd say a lot of it, we work with very close what they call private money lenders, and these lenders really are individuals or companies that are investing for individuals to hopefully be successful, right? So a fix and flip is really, you find a product, you want to improve on that home, you need the money, you've got a little bit of money to put down, maybe 10%, you have an after repair value of 50% or greater sometimes. And so one of the things you're able to do is get the money from both of them. You've got some of your money you got to put into. There's not a lot of qualification on the back end, and ultimately you're going to put that home on the market and sell it, right?
Okay.
So you really have to know about your aftermarket repair value associated with it. But then you have some individuals who want to buy a home, repair it, and live in there. And there's some traditional Freddie Mac and Fannie Mae products that are really good for that.
Okay.
So if I was an investor, the very first thing is, am I investing for equity, which means I'm going to hold it over a long period of time? That's one investment type. Am I an investor that's going to go ahead and invest for cash flow? That means I'm going to grab it, and I just want to be able to maximize the monthly cash flow on it. That's a different type of product I'd probably recommend. Am I doing a fix and flip? Then if it's a fix and flip, I want to do probably a private money lender. And if I'm looking for a long-term hold on the DSCR thing, again as well, I want to be able to understand what my philosophy is on equity or cash flow investing right there.
Gotcha.
So, but there's tons of I love working with investors because most of them understand it's not about the rate. Right.
Yeah.
It's never about the rate when you are an investor, right? It's always about the cash flow.
Yeah.
Period, end of story. So either cash flow or your equity. I'll give you an example. There was one point in which I owned 7 investment properties.
Yeah.
I lost money every single month on those. I had renters in them, but every single month I was putting $100 towards the mortgage. But when I sold them, though, all that equity I built on my home was 90% paid for by the individual who's leasing the property.
Nice.
Right.
Okay.
So I was investing for equity if that was the case.
Okay.
Right.
Gotcha.
And so you got so investing for equity or investing for cash flow or investing for a fix and flip, it all sort of depends right there. You have to understand sort of the differences associated with it.
Okay, gotcha.
Yep.
So on the flip side, for someone who maybe just wants to buy their personal home, that's where you would say is like basically don't take a loss on your taxes. Actually show them what you're gonna make, or do the
Just walk into it with eyes wide open.
Yeah.
Just understand.
And you probably need to do some more long-term planning, right?
Sure. I mean, I have a great relationship with my accountant, right? And he and I are actually friends, and he'll send me clients that are self-employed because he understands when he first started in the business, he didn't understand, I have to, if my self-employed borrowers ever want to buy a house, I have to be cautious about what they're writing off and their deductions. But, that's a conversation that we have to be very careful about, though, because I can't tell a borrower, well, this is exactly what you're doing, because that's steering. So, a borrower has to understand knowing, or a client, not so much a borrower, but clients need to understand walking into it that, I'm going to say the saying, you're either lying to the IRS or you're lying to the underwriter.
Yeah.
That's as old as I've been, for as long as I've been in this business, that has been the saying.
Yeah.
So it's just a matter of making choices. You're either going to pay for it via taxes or you're going to pay for it via your mortgage loan.
Okay. Gotcha.
But you also have different first-time home buyers.
Yeah.
So here's what I mean by that is I've got my first-time home buyers that are in their 20s. I will give a different strategy to somebody in my 20s than somebody in their 40s.
Okay.
Right? Reality is, so let's assume that you're a 20-year-old home buyer, right? Well, you haven't probably had the chance to write off all your taxes and do all the stuff associated with it, right? So I can show you how, okay, guess what? The younger you are, and I'm going to tell your whole audience this, the younger you are, look at buying a home. Because you can buy a primary home, and then in a year, guess what? You can convert that to an investment property and you buy a second primary home. You move out. And so I can show you at a very young age how you can create equity over a long period of time. The younger you are, it's better to start buying primary residencies and then converting them in the future.
Yeah, because
okay?
then when you convert them, that's when you can use the loan products I talked about, when you can just show how much the rental makes.
That is
so that
correct.
You don't have like 2 mortgages.
That is correct.
And the other thing that happens too is it's generational as well.
Yeah.
Because it's not like when my parents bought a home, they bought it knowing that they were going to be in it, or they got into the mortgage knowing they were going to be in it for 30 years. It's not like that anymore. And it used to be the average borrower stayed in a mortgage loan 5 to 7 years. I'm willing to wager that that's probably more like 3 to 5 these years. So you have a lot of first-time home buyers coming in whose parents either never bought at all, bought and stayed in the same home for 30 plus 40
Yeah.
years, or never refinanced.
Okay.
You know, because when I remember my parents divorced and my mom got the mortgage on the house, she was ecstatic that she got a 13% interest rate because at the time, that was a great rate. You know?
That's wild.
And the problem that we're seeing right now, and I do say this is a problem, the average home ownership age is now 34 years old.
Yeah.
Okay.
So
Should
it's
be
moved
lower.
way up, right? So I would venture to tell all my 20-year-olds, don't wait until you're 34.
Yeah.
The earlier you invest in real estate, the more equity and wealth you start creating earlier.
Yeah.
That is just the reality, right?
Yeah.
There's never been a period of time in any 7-year period in which you haven't had appreciation of 3% or greater.
Right.
Just the reality right
Yeah.
there.
And don't expect your first home to be a baller home.
Yeah.
Okay? Don't be
Yeah.
coming to me going, my friend got a $400,000 house. I want to buy that one. And
Yeah.
No, because I'll be the first one. I'll be the big old mama bear and
Yeah.
be like, no, we're not doing that.
Yeah.
Listen here, you know, and this is what we're gonna do. And
Yeah.
We're gonna start small and we build big.
Yeah.
I used to do a ton of loans in Atlanta. You want to talk about the self-employed capital of the world is Atlanta. And used to do a ton of business there. And I had this one young lady, she had been through a really horrific, abusive marriage. And her realtor was actually a friend of mine. And she was my realtor, then became my friend, blah, blah. Anyway, she got her out of the abusive relationship and got her into like a house, you know, where she was hidden. And then we were able to get her finances together within like 6 to 8 months, something like that. I forget the timeline. But we finally got her into a home in Atlanta once she, you know, because during this whole thing, she's still doing her maid services, which is her own business.
Yeah.
And we get her into her first home, and I want to say that house, she got it for like $185. I mean, it was very cheap.
Okay.
But it was in a safe area. And then 2 years later, 2 years later, she came back and said, okay, I'm ready to buy my next house.
Wow.
So, you know, she went from having almost nothing to
Yeah.
working herself to death to get into a house, got into the house,
Yeah.
and then 2 years later, I'm ready to do it again.
Man,
Let's go.
yeah, I love that, and I just love just something that's been on my heart recently is like don't skip steps. It's just been in my head like every day. Like
Yeah,
God's
and
been telling me
breathe.
that. Yeah, and I just
Yep.
like you have to just take the little steps to get where you want to go. And I really just want to encourage people is like take off the blinders of whatever you think you can't do. Right. So someone tells you you don't make enough money, or your credit's too bad, or you're whatever. Like, and you might be in those situations, right? Or maybe you can't actually afford to buy a house, but that doesn't mean you can't get a game plan together. That means you can't educate yourself like they've been saying this whole time.
And
Yeah.
it doesn't mean that you can't put the groundwork down.
Yeah.
I'll tell you something my granny Suda used to always say to me, and yes, that was her real name. She used to say to me, never ever accept a no from someone who never had the authority to give you a yes.
so good.
Never play small.
Yeah.
You know, you can lay your groundwork, and if you fall off your little path, it's okay to jump off, get back on, jump off, get back on, as long as you get back to it.
Yeah, man, love that. Thank you guys so much for coming on. This has been so just encouraging to hear. I love just talking to professionals who care about people, who really have done it a long time, and understand how to navigate the markets. And I love you talked about being a mama bear and just being able to be, hey, listen, no baby, we're not buying you a
I got
$500,000
stories
house. You're
for
gonna like.
days
So
about
anything
that.
you guys want to kind of last words? Anything you guys want to say? I know you guys have a new venture coming up. I don't know if y'all want to talk about that really quick, but yeah.
I would probably say my last words are the following. Don't be afraid to get engaged. Don't
Okay.
be afraid to get engaged. If you have a question, give us a call.
And you mean engaged
Don't
with
call
you guys,
him.
not like
No, I
getting
mean
engaged,
engaged in the
married,
no, I mean engaged in the market, right?
Okay.
I think there's so many people that are afraid to be engaged, and that if I see this, I hear this all the time is, oh my gosh, I didn't realize how easy it was going to be. I didn't
Right.
realize I qualified. I was told this. I was told I could not do this. So don't assume anything that you can't do. I'm a big rap guy. I love rap music, right? That's a
Okay,
big
who's your
thing, right?
favorite artist?
Well, it depends, right? Yin
Okay.
Yang Twins were my favorite in the 90s.
Okay, so you like the 90s guy.
I'm a 90s guy, but I'm about to
Okay.
tell you, my
I
son.
always
right
gotta
now-
check people.
Oh,
You say
but
you like rap. I'm like, what
but
kind of
my
rap?
son has Metro Boomin going right now. I got a lot of Drake going on.
Okay.
Yeah, so Drake, Metro Boomin, Future. I mean, all those guys. My son's like just like me. But how do you build a beat, right? So look at it this way, right? How do you build a beat in music, right? It starts off with the bass. Then you get the hi-hat, right?
Yeah.
So that's very similar to what what you have to get engaged in the real estate industry is.
Yeah.
You got to get your rhythm down, and you got to get engaged to create your own beat, right? Whether that be buying your first home or your 10th home. Get engaged in that process, and don't listen to somebody else who has not done it.
Yeah.
Go with the individuals who have.
So good.
So
Yep.
my thing, I kind of come at it from a different direction. I tell people all the time that financial is personal because it is very, your finances are very personal, and your personal choices affect your finances.
Right,
so it's very much a cyclical thing. What I tell borrowers, and I don't care if this is your 15th purchase or your first purchase, or if you're buying a $2 million home or a $150,000 home, I say the same things. First thing I say to when a borrower calls is, tell me what's going on. Tell me where you're at. What do you need? And then when I'm ending the call, I tell them repeatedly, I say it at least 3 times. I'll say, ask the questions, put it in an email, put it in writing. That way you're protected, I'm protected, everything's out on the table. And you're asking the questions because you don't know what you don't know.
Right. Yeah.
And I've learned a lot of my career has been built on just talking. You gotta talk.
Gotta talk. Yeah.
Talk to people, ask questions, get engaged. Just like Chris has said, dip the toe in.
Yeah. Let the universe know what you're trying to do. It will
Right.
reward you.
It will reward
if you do the work. I'll make you preface that.
Yeah,
Yep.
you will have to do the work. And mortgage lender's not here to hold your hand through everything, but we are here to give you a guidepost.
Yeah. So good.
That's our job.
Yeah, I love that. Cool. Thank you guys for coming on the Blueprint Podcast.
Thanks for having us.
We're going to have their information in the description. So if you have questions, we can definitely get engaged with the mortgage process with our friends at Rate. Feel free to hit that subscribe button. If you're still watching, I know you got some value out of this. So hit that like button, give us a subscribe, and then we'll see you guys in the next episode.